Welcome to the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. Today, we dive deep into the Treasury market because there's been a lot of activity, some major selling by countries like China and Japan, and major buying by legendary investors like Warren Buffett, who now owns over 4% of the entire U.S. Treasury market. So I invited Eurodollar University founder Jeff Snider on the show today to help me determine what's going on and what this means and what the motivations are for the various parties. Right before we jump in, I'm hosting my annual conference on January 19th and 20th. This is the Vancouver Resource Investment Conference. Come join over 8,000 investors, hundreds of keynote speakers, hundreds of mining companies exhibiting on the trade show floor. This year, our keynote roster is off the hook. Robert Kiyosaki, David Rosenberg, Danielle DiMartino Booth, Grant Williams, Rick Rule, Pippa Malmgren, dozens and dozens more. This is an absolute behemoth of a conference, and if you have any interest in allocating capital into the commodity sector, you can't afford to miss the Vancouver Resource Investment Conference. There's a link right beneath this piece of content to check it out. Here is Jeffrey Snider. Enjoy.
This is Jay Martin.
All right, here I am with Jeff Snider. Jeff, it's great to have you back in the program.
Oh, it's great to be back, Jay. Thanks for having me.
So here's where I want to start today. Whenever there's any selling in the Treasury market, specifically by like a large country like China, the hyperbole and sensational headlines just take off, right? And so there has been some selling pressure, a lot of selling pressure by China, by Japan, and immediately the headlines are claiming, China is dumping U.S. dollars. They are seeing massive cracks in the U.S. system. Let me ask you, because this is what you do, when you see this kind of activity, how do you begin to form a thesis? So China and Japan have been selling. You want to determine what's really going on. What do you do next?
Well, the first thing you do is look back through history, because it's not the first time it's happened. And so the easiest thing to do is to correlate what China's doing with U.S. Treasuries. And you can use the TIC data. That's the Treasury International Capital data that the Treasury Department puts out. And that's usually where all these headlines come from anyway. So you go through the TIC data and you look at the history and say, okay, China sells treasuries. This is not the first time they've done it, nor is this the first time they've done it as nearly as heavily as now. They have sold a record amount over the last couple of quarters, the first quarter of this year and the third quarter. That's what's got everybody talking. But this is not the first time that they sold treasury. In fact, they sell treasuries in bunches, and these bunches tend to cluster together with other signals that we see throughout the system. So the easiest thing to do is just to plot the TIC data against other financial metrics like the US dollar exchange value against the China's yuan, or something like US dollar swap spreads, or even just the US Treasury yield curve. And when you do that, you easily debunk all of these media headlines, because what they're saying is China's whatever reason that China is selling, it's bad for treasuries, it's bad for the dollar, it's bad for the United States, because you've heard that for decades. If China ever gets to decide that it wants to sell U.S. treasuries, then treasury market's dead. It's going to blow up. It's going to be a bad day for treasury holders. But what you see is the opposite. When the Chinese start selling treasuries, treasury yields are usually going down. Same thing with swap spreads or Chinese currency. China is selling U.S. treasuries at the same time its own currency is going down against the U.S. dollar. So just from that alone, just straight facts, you see that the media narrative, the mainstream narrative it just doesn't line up with reality. Like I said, because this has happened repeatedly over the last decade and a half, it's not like a one-off. It's not an outlier. It's not like something you say, okay, maybe this time is different. It happens the same time every single way, or it happens the same way every single time. So obviously we're missing something here. So, and that what we're missing is why are the Chinese doing what they're doing? And as you said, it's not just China, it's also the Japanese. What are we missing as far as what they're doing? And why does that correspond with interest rates going down or swap spreads compressing, becoming more negative, or the Chinese yuan getting weaker against the US dollar if the Chinese are selling US dollar assets against, what should be, and it sounds intuitive. It should be that, the US dollar should be going in the other direction. So that's the first thing you got to do is just look at the evidence. I keep saying, just look at the stupid charts that's right there in front of you. So that's where you start.
And so with this recent record selling the last few quarters, what is your answer to why the Chinese are selling treasuries in this volume right now, Jeff?
Well, what it always comes down to is the dollar scarcity. That's why you see all of these other signals, starting with demand for U.S. Treasuries. Why do interest rates go down? It doesn't have anything to do with the Federal Reserve. Interest rates go down, especially when you get into the marketplace, longer into the yield curve. Interest rates go lower because lower growth and inflation expectations, higher demand for safety and liquidity, which tells you something about perceptions of safety and liquidity. And so if there's a heightened demand for safety and liquidity in the US dollar system, that's usually because there's less liquidity in the US dollar system. And that creates all sorts of negative consequences all throughout the rest of the world. And in some cases, it causes, as we've seen these repeated cycles, it causes various governments around the world to try to respond to these scarce environments where dollars are increasingly scarce. And sometimes these other nations around the world have to sell their reserve assets in order to subsidize or supply scarce dollars into the marketplace. So if the Chinese are selling their treasuries, that means that they're selling their reserve assets, not because they hate treasuries or America. They're afraid of President Trump or anything else. They're selling their treasuries to mobilize the reserve assets to use them in the local system. So all these things go together. You see all of these signs for dollar scarcity. You see signs for lack of flow in liquidity and a circulation and redistribution among all the money dealers in the global system. And of course, in that environment, you would say, okay, it makes sense why foreign nations would have to mobilize their reserves to do something about that issue.
And when you say mobilize their reserves, effectively they're selling treasuries to raise cash to deploy into their economy, probably to fix something or avoid some kind of a crisis, correct?
Yeah, because you have to keep in mind, in the reserve currency situation that we have, everybody needs dollars. You have to have dollars just to participate in the marketplace. And we also have to remember, China isn't China. It isn't, a monolithic one nation. It's all the same. It's like the United States. The United States is a conglomeration of, especially in a commercial setting, all these different businesses and banks and financial firms all around the entire system. So the Chinese are not just China. And so there are different parts of China that might need more dollars than other parts. Like, for example, Chinese exporters have tons of dollars because they sell more goods than they sell goods on the global marketplace. And so they have dollars coming in all the time. But those dollars don't necessarily become immediately available to those on the other side who are trying to import stuff into China that need to borrow dollars from somewhere. Mm-hmm. And if they get them from the marketplace and the marketplace is, I don't really want to lend to you, Mr. Chinese importer. And where you're going to get those, so even though China has a massive merchandise surplus where there's lots of dollars coming in, it doesn't necessarily mean that those dollars are immediately available to the entire Chinese system. So you could have, and you have to keep in mind too, that it's not just merchandise flows. You have to factor financial flows too. So you have Chinese financial firms, which of course they're under pressure in dollar terms because the Chinese financial system, especially it relates to the offshore dollar market, is completely messed up after the defaults and everything else that's happened with Chinese developers over the last couple of years. So you can see why there might develop periods where there are tremendous amounts of dollar strain on specific parts of the Chinese system. And as that dollar strain goes together with dollar scarcity, the Chinese government is going to intervene as much as it can to make sure that the situation remains as stable as possible. And that includes trying to manage the currency exchange value and make sure it doesn't get too weak or is weaker than the government in Beijing is willing to tolerate. And that necessitates at times that the Chinese government has to supply reserves into the system in order to manage the currency exchange value, as well as this need for always acquiring and using dollars.
Let me ask you a question that's going to sound kind of maybe rookie or beginner, but I'm trying to battle with this right now. So why then? Because whenever there is a massive treasury sell-off, and let's stick with China as the example because they're the most frequent in the headlines, the assumption made by financial journalists and investors all over is they're dumping U.S. treasuries. There must be something wrong with U.S. treasuries. They're diversifying out of U.S. dollars. That's another big one, right? And into something else because they've lost confidence in U.S. dollars as their reserve asset. It's not a big step to what really occurred is that in fact, when you sell treasuries, it's because you're raising U.S. dollars because you need U.S. dollars for something, right? And it could be the developer issue, could be, for imports. I'm not sure what. But that's like, it's not a big step to what happens next when you sell treasuries. You receive dollars, you deploy them. Why is the disconnect so consistent? Therefore, Jeff, like, what do you think? Because it's not a. Have I summarized it effectively? And if so, why do you think the disconnect exists every single time?
Well, part of it is just plain ignorance. It's, nobody really understands what a reserve currency is, especially people talking on social media and even the financial media. They don't really understand what the reserve currency system is and how it operates. And so all of this stuff is sort of like black box material. And like any good superstition, when you don't know how something works, you just fill in the blanks with whatever seems plausible to you. And if we also keep in mind too that most people have an agenda. They're selling something, and they have a narrative that they're trying to continue. They're always trying to sell a narrative. So it sounds like if you've got a political axe to grind, then Chinese hate America. There's an entire. It's not even a cottage industry. There's a very large industry that's dedicated to selling dollar doomism. And so if you're selling dollar doomism for various reasons, and along come the Chinese selling treasuries, you don't really understand how the reserve currency system works. You can sell a dollar doomism narrative by saying, look, the Chinese are selling treasuries. They hate America. They hate US. I was right. The dollar is going to zero. And then, of course, nobody ever does any homework and goes back and says, okay, the Chinese have sold treasuries before, and the dollar does the opposite of what you say. The treasury market itself does the opposite of what you say. It's really just this entire paradigm of ignorance. And a lot of it goes back to the Federal Reserve and economics, who've done a horrible job where it comes to understanding monetary systems and how they work. And the Fed doesn't really know itself. So really what's left is the public is just flying blind here. We have no idea what's legitimately happening. Nobody really does any homework. And so you have these credible sounding people who have narratives and they have agendas and they keep telling you it's dollar doomism, or they have, the treasury interest rates have to skyrocket. And they never actually do, because nobody really understands how all of this all fits together. And like, it doesn't take more than a couple seconds to see this.
So one assumption we could make, therefore, off of selling pressure in the treasury market is fractures elsewhere, right? It doesn't say so much about the U.S. market as it does about whoever's selling in order to raise cash to deal with something. When you look at the globe right now, Jeff, there's a lot of conversation about a coordinated recession, coordinated depression. Where are the fractures? Are there fractures that stand out to you as the most significant? Are they in China? Are they in Germany? What stands out to you as the most vulnerable geographies in the global economy?
Well, yeah, it's pretty global at this point already, but yeah, you hit a couple of them. But I do want to go back, if you don't mind, Jay, just to finish up on the last question.
Yeah.
Part of it is that, we look at where the treasury market is today. People think, well, the treasury, you hear all the time, yields are skyrocketing, yields are soaring, yields are going up. So how is that not what the Chinese are doing? You have to keep in mind that behavior of markets is not monolithic either, nor is it go in a straight line. So while interest rates are up in the marketplace since September, they're actually lower than they were a year ago. They just go back and forth along the way. And so as you started out to show, every time rates go up, even for a couple months, you hear this, treasury market doomism, inflation is back, sticky inflation, the Fed's not going to cut rates. Every time there's a fluctuation in the market, the narrative shifts. And so in one sense, not only do you have to step back and look at the reserve currency, you got to step back and look at the marketplace too, and realize that there are these short run fluctuations that happen all the time. We saw one earlier this year. We had the big bond rally last year, October, November, December, bottomed out. And then over the next 4 months, interest rates went sideways to higher. And while interest rates are going sideways to higher, you heard the same exact things. It wasn't necessarily China, though. The Chinese sold a bunch of treasuries in the first quarter too. And so it's filling in the gaps with not having a perspective on the fluctuations in the marketplace, as well as understanding how all of these things fit together. But the second part, dollar shortage is usually all about money dealers in the Eurodollar system becoming more and more risk averse. So they have to have something that causes their risk aversion, which usually in the post 2008 era has to do with setbacks in various parts of the global economy. And you hit a couple of the big ones. One is Europe, which was supposed to be recovering from its recession. It's been in an unofficial recession for 2 years now. And rather than coming out of it like everyone was expected this year, it's actually looking like it's going to get worse heading into next year. So you've got a major economy that is struggling in a whole bunch of other ways to begin with, that was supposed to be recovering and instead is actually somehow getting worse after a 2-year long recession. that's going to cause enormous pressure on just in terms of the economic system, but also in terms of the Eurodollar system itself, because you've had a bunch of European banks that have gotten back into the redistribution and circulation of assets and money and credit and collateral throughout the Eurodollar system over the last couple of years. So the worse it gets in Europe, the more pressure that is on a key redistribution node for the entire monetary system to begin with. So that certainly plays along into it. A big one, of course, is China. Everybody knows China. Everybody knows the Chinese economy is in big trouble. Everybody knows about the real estate bubble there. And what the Chinese have finally admitted is that they do have a big major problem. And in September, they decided that they were going to try to do something about it. But I don't think they really know what to do either. And I think the marketplace has started to get the sense that they don't have an actual plan, that the plan to rescue China was basically to throw around these massive numbers and hope that the market would do the job for them. Like if China said, I'm going to borrow 10 trillion yuan over the next couple of years, everybody would just be like, oh, that's a huge number. Let's start doing positive things again. Let's start taking risks. Let's start getting back into the real estate marketplace. I really think that was the intention. The government would just throw around big numbers and then the market would magically heal itself. It's very Western and Keynesian. But that doesn't necessarily work. In fact, it really doesn't work. It's that kind of a sentimental attempt or that sentimental strategy. And that's why you've seen markets completely turn around. I mean, I was going to talk about today in my video on YouTube. Chinese government bond yields are back within a couple basis points of their record lows already. So that you have lots of pessimism as well as obvious strains building up in China. And then you have the United States. The United States, which is supposed to be strong and resilient, soft landing, everything's going really well here. Then we hit the summertime and it's like, wait a minute. Soft landing was guaranteed. Sticky inflation was supposed to be the biggest risk. And then all of a sudden, everybody's talking about weakness in the labor market and recession. And while the mainstream talk of recession has disappeared, it actually hasn't from the actual data, especially the labor market. The establishment survey is a big one. Everybody keeps pointing to payrolls as strong and resilient. But the last several months of payrolls show that it's moving down sharply, and we know the payrolls are overstated to begin with. So even though the United States might not be in a clear recession right now, the potential and path moving toward one continues to grow, not lessen. So you put that in the context where the major economies around the world, the best one of them is facing serious downturn or serious questions about a downturn. That's the best case. You can understand where risk aversion comes from, and therefore where you have monetary scarcity and tightness around, all throughout the monetary system, the financial system too. And then we got a reminder on top of everything in early August with the yen carry trade reversal about maybe how fragile the monetary system and financial system can be too. So you throw all these things together and it starts to make a lot of sense.
So you touched on China, Europe, USA. I want to maybe go and pick those apart one by one. Let's start with China because you talked about, back in September, they announced they're going to start to try and do something, and you're referring to their massive stimulus package they've begun to announce. So that's a really interesting take because when I heard that news and saw the numbers they were throwing out, I thought it was going to be a major event, Jeff. I'm not kidding. And I was using maybe 2008 as my benchmark because what was it? The 4 trillion yuan bazooka was the announcement in 2008 that eventually became 9.5 trillion in stimulus over 3 years. And the commodity market that came out of 2008, largely fueled by demand in China. You could say a great growth story. You could also say 10 trillion in yuan was, flooded into the economy that stimulated this growth. And I was wondering first of all, I'd love to know your thoughts on my analysis of that. And then I made the next jump to this is potentially a very similar setup. That's what they're looking for. Maybe that could occur. But from what I've heard you say, it's not at all the case. So what's your take?
I think I think that was the intent. The idea was to get the marketplace to think, okay, we're going to do something like 2009, and therefore everybody gets really optimistic and everything starts to move in the right direction based on purely expectations and sentiment. Like I said, it's very Western Keynesian. But there's night and day difference between China today and China in 2008. China in 2008 had yet to experience anything like a downturn. And that massive stimulus was pouring money on top of an economy that was largely still intact. In fact, it was still doing really well at that point. And the intent was simply just to try to buy China some time until the rest of the global economy and eventually recover, and then everybody could go back to normal. That's what the Keynesian textbook always says. But in 2024, really 2022, 23, and 24, China has experienced more than a decade of sliding into the abyss. And they have, on top of that, the legacy of 2008 and 2009, because what happened was they used essentially that platform to establish China's real estate bubble. The real estate bubble was their response to the 2008 crisis. So like you said, there was lots of activity in 2008, but by 2024, they have the bubble, but none of the growth. So China today is in such a big hole that it wasn't in 2008, that this is where the Chinese don't really know what they're doing. They're hoping the market solves the problem for them. And so what they're really announcing is big numbers, broad strokes for potential outline of a plan. And it's not even the same type of plan, which I think the market has figured out. In 2008, there was a lot of direct spending. There was also a lot of lending toward, especially local government financing vehicles to do all of this, to accomplish all of this stimulus in the real economy. In 2024, the local government financing vehicles are bankrupt. I mean, they're completely bankrupt. And it's to the point that local governments in China, the reports and rumors are true, they can't even provide basic services. So a lot of the money the Chinese central government is going to borrow isn't to pile into the real economy. It's to bail out the past economy that's already in really rough shape to begin with. About $1 trillion, at least so far, is going to go to a debt swap where they swap out debt for these local government financing vehicles. And it will probably be a lot more than that. They've also talked about $1 trillion yuan recapitalizing they've said the largest 6 banks. They've said large banks. They really haven't provided a whole lot of details. This goes along the same thing. Back in 2008, they didn't need to recapitalize the banking system because it was already well capitalized. It was relatively healthy and moving in the right direction. So basically, in big picture terms, what the Chinese are announcing is they're looking backwards, trying to bail out all the mistakes over the last decade, not trying to pour money into the real economy. And that's the part that I think a lot of people in the marketplace are disappointed about, is that there isn't any plan, at least there isn't any today, to actually do direct Keynesian stimulus, because they have to do all of this all these other bailout type of programs. So it's night and day difference, 2024 and 2008. And I honestly believe that they don't really know what to do here other than try to bail out all of these bad loans and bad debts and bad sectors and hope that's enough. It's sort of like, just let's throw some money at the problem and just hope it fixes itself. And I think that's why a lot of the markets have turned around. Initially, there was a response. You look at Chinese bond yields. There was a little tiny bit of a rise in yields, which would be positive, higher growth and inflation expectations. But like I said, over the last couple of months, they've just right back down into almost record lows. In fact, the 10-year today, I think, is only a couple basis points off a record low. So the market was not really all of that optimistic to begin with. I mean, certain markets like stocks obviously did. They bought into it, but then stocks always do the same thing whenever China does that. Some commodities, there was definitely a sharp bounce in like copper, aluminum, even iron got into a little bit of a bounce there, but those have faded, as well as I think the marketplace starts to realize that this is much bigger than was anticipated at the start.
Yeah. Okay. Thank you for that context. And so 2009, completely different Chinese economy. So you can't really pull that parallel forward. And yes, we print cash. They effectively printed condos, right, to grow out of that 2008 crisis.
The last thing they want to do now is print more condos. That's
right.
I don't know if you've seen some of the numbers about the overhang in supply in China. It's just, there's something like 90 years supply of homes in China. I mean, that's probably at the upper end, the most extreme end, but that's credible sources are saying we have no idea how many houses we even have. So, I mean, that removes basically the major playbook that everybody appeals to in this situation. If you're into an economic, you're facing an economic downturn, stimulate the real estate market. That's the easiest thing to do. Well, they can't do that. And so what else is there? Yeah. And it's not like the Chinese industrial economy is flourishing either, where you can build a little bit of extra industrial capacity, knowing that a couple years down the road, the rest of the world economy is going to demand it. So there really is no traditional angle that the Chinese can depend upon to try to spend their way out of this mess. And so they're really, let's bail out the local government financing vehicles. Let's bail out the banking system and hope that's enough. What the market's saying is, it's not going to be.
Right. Yeah. $1 trillion to the banks, $1 trillion to local governments. I saw that. $1 trillion direct to consumers to incentivize them to sell their appliances and buy smart technology. So effectively stimulating consumption on a very direct basis. 90 million years of home inventory available. Did I hear that correctly? Is that the estimate?
No, I mean, nobody has any idea. I've heard one of the former head of the National Bureau of Statistics said that he thinks there's, I want to say 3 billion unoccupied homes in China, which is close to 90 years supply. And I mean, that's, those are probably upper end. Some of the more conservative estimates, which sound conservative next to that, are like 500 million homes unoccupied, which is, if that is a mind-boggling number, 500 million unoccupied homes, even as a country as big as China, that's just absolutely insanity.
Yeah.
So, I mean, that's a huge overhang to tackle. At the same time, you're trying to do something about the current economy today. It's a very tall order.
Okay. And not super strong immigration numbers going into China to fill those vacant homes. Okay.
Yeah. I mean, like you said, they just printed condos, just hoping that eventually at some point, regular economic growth would take over. They wouldn't have to continue to make more.
Yeah. Okay. Let's move on to Europe. Mainly, I've seen Germany, France headlines that strike me as concerning. What are you focusing on when you look at the European economy? Are you country by country? Do you tend to group economies together? How do you look at it, Jeff?
I think you start out with the individuals and then see if there's any spillover, any second and third order effects around the rest of the economy. You're right. Right now, Germany over the last 5-6 years has been a complete basket case, and probably worse than a basket case. Germany is a disaster. They've basically hollowed out their entire industrial base for a variety of reasons, including political reasons, which has left them with basically nothing. They've been basically hanging on through a couple of other, the auto business is one, but that's where the real current danger comes in, because the automakers who have been sort of hanging in there for the last couple of years, based entirely on the price illusion of the last, the supply shock, where they've been taking more revenue per unit that they sold. Therefore, that protected the automakers against the consequences of the 2020s economy. That has diminished to the point that now automakers are saying, we sell millions fewer of cars in Europe. What do we need all of these workers in factories for? So one of the ways in which Germany has been able to avoid the consequences of its industrial destruction has been the auto business, really the generosity of the auto business over the last several years, just getting more profit per unit. And now that the profit per unit is disappearing, the auto demand for autos is diminishing. Now they're talking, Volkswagen, first time in its history, we're going to have to close factories in Germany. Now they're talking about 3 factories, and maybe tens of thousands of workers are going to be laid off. That's a big problem for Germany, but it's not just a big problem for Germany, because as the auto business starts to tip into real nasty contraction, that's going to have a spillover impact around Germany, especially in some of the former Eastern European countries, former Eastern Bloc countries that have developed in a lot of ways to supply parts and labor to the German auto industry. So Germany has been incredibly weak and continues to get weaker, just defying all expectations for a recovery this year too. At the same time, now we're starting to see weakness develop in France and even Italy. Italy, which had performed really well in economic terms over the last couple of years, starting to show signs that that's cooling off, maybe slowing down and rolling over as well. And then around Germany, some of those Eastern European countries are suggesting that they're seeing the weakness develop there too. So Europe has major problems at the center in Germany that are structurally related, and then you have cyclical problems on top of it, which really leads to a potentially toxic mix. Weakened industry in Germany, and then cyclical autos, and it's not just autos; there's a bunch of other industries as well. But the goods economy and trade in Germany falling off, and we're starting to see signs of spillovers around the rest of the European economy. It makes for really difficult circumstances.
What would be the linchpins in France, Jeff? And we talked about the auto industry in Germany as maybe one primary vulnerability. What about France?
France is in the same boat in a lot of different ways. It's not in the same, not as far down that same road. France has a heavy industry in terms of autos as well, but also, aerospace is in there. And it's basically the fact that, it's not the bigger picture terms. It's the fact that Europe never really recovered from 2020. The rest of the globe never really recovered from 2020 either. But in realizing that the 2020 and 2021 wasn't actually, we didn't really recover from, that leaves these, especially weaker economies, more vulnerable to the setbacks as we see the downside of the supply shock begin to emerge. In Germany, there's less protection from industry outside of autos. Therefore, that has emerged more quickly. Whereas in France, you have a heavier government, I don't call it stimulus, but a heavier dose of government intervention in the economy that has allowed it, like the United States, to basically obscure this downside emerging. And so as it continues to merge more and more, we're seeing the negative and second, third order consequences from that downside emerging, where it's having both a cyclical impact as well as a sentimental one, because a lot of participants in the economies there have been expecting, as I said in the beginning, that Europe was going to recover this year. 2024 was going to be the year that Europe recovered, because all that weakness was just, a little minor setback, a little minor slowdown that most people attributed to the ECB and its rate hikes. So if the ECB was going to start cutting rates, then Europe's problems would be over. And what's starting to really emerge and really settle in Europe is the idea that it wasn't the rate hikes that caused these problems, that is much deeper and more structural, combined with these cyclical aspects of the economy, leaving Germany, France, and everybody else around them, including Italy, the biggest economies, susceptible to more cyclical forces than was anticipated and moving in the other direction. So the idea that rate cuts were going to solve Europe's problem is finally being, revealed as a false assumption. And that has left Europe in a really bad spot, because now you have a whole lot of businesses that were expecting an upturn in business now seeing a downturn, and therefore it leads to real negative consequences potentially in the labor market, most of all, which is the one aspect that we've been missing so far. So it's not really industry specific. It's more of this process where up until this point, as bad as it has been, at least the labor market has looked relatively steady. Of course, Germany, the unemployment rate has risen more than all other places, but we've only seen a modest increase in unemployment across Europe, which is threatening to become more than a modest increase. That's really where the danger lies here.
Okay, and you made a similar comments in the United States in regards to payrolls. And so maybe let's pivot there next. When you analyze the American economy, where do you see the vulnerabilities right now?
That's the biggest one, because up until really the last 6 months, it started around March and April. It really goes back to last year, but there was an inflection in the labor market around March and April that I don't think a lot of people picked up on, because the establishment survey payrolls overstates the payroll growth in the labor market. So the payroll data didn't look all that bad, while other sources on the labor market picture, they started to really turn around much earlier than that. So most people, their perception of the labor market is, okay, payrolls look really good. And then even in the summertime, they only slow down a little bit, at least to the initial estimates. So if all you're looking at is the payroll report, the headline number, the U.S. labor market looks relatively healthy and robust. But you look at other sources, including the household survey, which is where the unemployment rate comes from. The household survey has been flat to actually lower for the last 13 months. Going back to October, the household survey has said there are no jobs. There haven't been a whole lot of layoffs, but there has been nobody really hiring. And that's backed up by another BLS number, which is JOLTS in hiring, not the job openings number. That one's worthless. But the hiring rate from JOLTS suggests that what the household survey does, that there has been basically no hiring going back to at least last year. And that is absolutely consistent with anecdotes and stories that you hear from people who are looking for jobs. There's nobody hiring out there, as well as all of these company reports that we got over the summer and into the fall, suggesting that consumers are really struggling, especially the retailers like Target just recently. So all of the labor market in the U.S. does not look like the headline establishment survey, at least until the October report. And then the BLS revised the establishment survey and said, you know what? Guess what? The labor market actually was substantially weaker during the summer than we thought it was. The August payroll report was revised down substantially. September was a big number that came back. And then October, which people have written off as, hurricanes and the Boeing strike. But even factoring those, October would have been another weak number to begin with. And then, of course, again, keep in mind that the establishment survey overstates everything. We just got the QCEW, which is the quarterly census on employment and wages, which is what the CES numbers are actually benchmarked to. And that one was, if it only goes up until the second quarter, up until June. But the June number looked every bit like an economy falling into recession before we get to the summertime. So the U.S., a lot of expectations and interpretation analysis of the U.S. economy starts with the labor market for what are really good reasons, because it looks relatively healthy. But when you look underneath the surface past the headline payroll report, it looks a lot weaker than most people are anticipating. And if the labor market is indeed getting weaker, as we see the unemployment rate has been rising over the last year as well, then that changes a whole lot about the future prospects, short-term prospects of where the U.S. is actually heading. And you put that into the context where Europe is heading back into recession, China can't get out of its own way, and it really does lead to growing pessimism, flight to safety, that type of behavior.
Would you see that as related at all to Warren Buffett's moves out of the market? I mean, this is like the most prolific American stock market bull of all time, suddenly massively reducing positions, cashing out, cut his Apple position down by over 50%, cashed out billions from his Bank of America position. And now, I believe he owns, is it 4% of the U.S. Treasury market?
He's rolling into it, right?
Yeah.
I think that's, nobody knows what his decision-making process is. I mean, think we have an idea. I mean, he's been pretty open about how he does it, but we don't know why he's selling. Yeah. To me, it's not the selling, it's the lack of reinvestment. Like you said, the second part. Seems like pretty he doesn't like Apple. He doesn't like Bank of America. Okay, fine. But why not buy something else, right? I think that's the part that we really focus on is, okay, Buffett is saying, I don't like these stocks for whatever reason. We don't know what those reasons are. But the fact that he's not reinvesting the proceeds into something else that's, similar in terms of risk profile, I think that's the part to focus on. The timing, as well as the fact that he's saying, I don't like the valuations here. Now, that could mean a couple things. I mean, it isn't necessarily a negative commentary on the economy like I would have it. Maybe Buffett's just saying that stocks are overpriced and he wants stock prices to go back down for some reason, although that tends to relate to negative economic circumstances. But it might just be everything's overvalued here and he would like to see a correction of stock prices, maybe independent of cyclical considerations, though I don't think that's not my opinion, but we don't know for sure. And I think, like I said, the biggest thing to focus on is the fact that he doesn't want to reinvest proceeds in anything at this point other than safety and liquidity.
Could it be, when I saw those moves, I thought, if he's sitting on 300 billion or 315 billion in cash, and most of that's parked in treasuries, he's earning 15 billion in new wealth every year by sitting on a risk-off asset. And if that's an option for you, I mean, it's going to take a really good pitch to do anything else. He's still a frugal guy, billionaire or not. He's still the famous, McDonald's drive-through and gets the 2 patties if it's a good market. If it gets 1 patty, if the market's down, he pinches every penny, so it seems, or so he claims. And so if one of your options is to sit back and collect 15 billion in cash every year, maybe that's enough, right? I mean, could it just be like, that's a great option and show me a better one. And if you don't have one, I'm doing this. And maybe that's actually the motivation instead of, maybe what you said, cashing out of Apple, cashing out of Bank of America, who knows what, but this is just a great option.
Yeah, like I said, we don't know what's in Warren Buffett's head, but that's obviously part of the consideration, right? It lowers the threshold to sell those other assets because let's face it, he's won huge amounts. They've appreciated by a huge amount up until now. So he's thinking, okay, take some money off the table. And the fact that I can get a decent rate in treasuries means it's much easier to do that. And it also raises the threshold to reinvest into something else, right? If you're going to get 5% thereabouts in treasuries, we don't know exactly where he is on the treasury curve, but, average just 5%, relatively safe, totally liquid. It raises the bar to, okay, you want to buy something else to do something better. But I still think there is a little bit of a cyclical indication in that as well, because what he's saying is, I don't see that. Even though I'm getting a decent return in treasuries, I don't see anything better than just earning 5% in treasuries when his whole business model is to find something better than doing 5% in treasuries. So even in that calculation, I think there's a little bit of a pessimistic expression by him not doing anything other than just let's sit in treasuries to see how everything shakes out here. And then even if it's just, I think stocks are overvalued, then why are they overvalued? And if they are overvalued, why would they correct? What is the reason why they would do so? So I think you're left asking the types of questions that lead you into the direction of everything we're talking about here. Well, and again, we don't know exactly for sure what's going on, but it seems like there's a reasonable case to be made for that interpretation.
That interpretation being a globally coordinated downturn of some type. Yes.
Well, in Buffett's estimation, it would be all about risk, right? It's risk versus return. And so I've got a ton of return. I've got the returns from the marketplace. And if I'm seeing rising perceptions of risk, then calculation has shifted. I take money off the table, play it safe for a while, and wait till valuations and really the risk adjusted returns start to go back into his favor again. So I think in those terms, Buffett's thinking, okay, made a bunch of money, risks are rising. Let's just sit here and see how everything works out.
Are you seeing any other sort of hallmark investors making similar moves right now and de-risking in a big way, Jeff?
I don't really pay that much attention to the stock market, so I really wouldn't know. Sure. Because for me, stocks, they don't tell you anything about the fundamentals. Stocks have nothing to do with the real economy. I know we talk about earnings. We talk about, stocks are a discount mechanism for the health of the U.S. economy and the global economy or whatever. That's another one of those things. Just look at the chart and it's easily disproved. So to me, stocks really don't hold much value except when you see potentially some divergences. And I highlighted one recently, the Philadelphia Semiconductor Index. Semiconductor is a highly cyclical business which should be obvious reasons, because the computers and the fact that computers are in every bit of good, every good that we now buy. So semiconductors are a heavy cyclical business. And up until July, which is again goes back to this very same period in time that we started out with, that in the U.S. economy and a lot of places around the world, the summertime really seemed to be a shift in everything. So we see the semiconductor index, the SOX, correspond very closely with the S&P 500 up until July. And then from July forward, the SOX is now corresponding very heavily with the the Nikkei index in Japan, which, there's a whole other can of worms there. So you see, look at stock market overall, when, the Philly Semiconductor Index and the S&P 500 really should not correspond that closely together for a multi-year period, because they're supposed to be focused on different things. So that's just, okay, the two of them are trading together because that's what markets do. And then the one starts to behave differently than the other. I think that's what you pay attention to, because the one especially is a cyclical indicator that tells you, okay, even stock market investors who are usually preoccupied with everything other than the economy are starting to say, well, let's hang up a minute here. Let's see what's going on in the semiconductor business. Maybe like Warren Buffett, if we're right about what Warren Buffett's doing, maybe now's a good time to not only sell some of these semiconductor businesses, semiconductor shares, let's not reinvest them in other semis either. So there's a potential divergence there, which is one of the few kind of fundamental signals that I pay attention to in stocks, and there's a couple other ones too, like between Germany and France, for example. So you see a couple of divergences that have developed over the last 3-4 months that suggest even parts of the stock market are starting to see the same thing as we think we see of Warren Buffett, which is that there are rising cyclical risks in the U.S. and around the rest of the world.
Do you put any emphasis on the new American establishment? We've got our new president coming to power very shortly, maybe a bunch of new policies. Any significant impact to the American economy, Jeff? Or do you think the cards are already laid and outcomes are outcomes, and it doesn't matter who's in the White House? What's going to happen is going to happen. What do you think?
Well, there's surely a sentimental impact, because we've already seen that in a lot of different ways, which, a lot of it is, it's not really partisan. It's, we saw this in 2008, 2009, the outgoing Bush administration, incoming Obama. Everything was melting down. The world was a disaster. And everybody thought, okay, Obama comes in, different is good. At this point, whatever just happened was a complete disaster. So anything different is good. And of course, it didn't turn out to be any different at all. Even though it sounded like it was going to be a lot different, it didn't really make all that much difference. And I think there's that tendency every time this happens to put some, there's a sentimental impact that, okay, this one is different. Something big has changed. So maybe this will work out in our favor, especially since the most recent past has not been good. Things moving in the other direction. So perhaps I should be a little bit more optimistic and hopeful that, okay, Trump will be different from Biden. That will lead us into some type of difference as far as the economic trajectory goes. But history shows, again, it's presidential elections don't really change much as many people think, even though some of the policies could be radically different. I think one of the major mistakes that we make is we always attribute everything that happens in an economy to some government somewhere, whether it be the Federal Reserve as an agency of the government or the fiscal capacity of the government and the willingness to use it. When overall, the economy is the economy, regardless of the government. The government's ability to impact and to change the direction of an economy is exceptionally limited. But we don't hear that anywhere because we have this, we've been conditioned to believe that everything goes back to some kind of central authority. Mm-hmm. And so in the context, what we're saying now is that, if the global economy did indeed stumble badly in the summertime and is heading in the wrong direction, there is very little, even if Trump was going to be very effective in all of his policies in every way possible. First of all, it would take quite a bit of time to enact all those policies and to have an impact in the real economy. And we're talking, he's not going to be inaugurated until January 20th. And then you have to get everything through Congress. And then there has to be a lag. There's always a lag with that. So even if his policies were absolutely perfect and effective, you're talking about next year before they have any impact. But beside that, if the economy around the rest of the world has indeed stumbled during the summertime, then it won't matter what the U.S. presidential election is because the direction of that everything's heading is already baked into the cake. And so I think that's why you see the market behavior the way it is because after the short run positive sentiment from the election, okay, something different happened. The realization is that, okay, something different happened, but it won't make a difference over the intermediate longer term anyway.
Okay. So just to paraphrase what you just ended with there, if the global economy did in fact stumble in the summer, then the result is likely already baked in the cake, no matter what policies we see in the pipeline in January. What are you going to be looking for to gain conviction in that thesis that in fact the global economy did stumble significantly enough in the summer that the result is already baked in the cake? Where will you look for evidence one way or the other?
You see a lot of evidence already. It happened during the summertime. Some of the market signals that focused on, especially, like I said, Eurodollar redistribution, what dealers are seeing in their perceptions of risk. So we got interest rate swap spreads that continue to get more and more negative, which is a negative signal specifically tied to forecasts and projections for interest rates. And when you have a longer dated interest rate swap contract or interest rate swap market, where you see more and more negative interest rate swap spreads, what that suggests is that this big, sophisticated, wide, far-reaching marketplace that has all of the major players, this is basically the middle of the monetary system globally, has become so hedged that it believes that interest rates are going to go down and stay there. That doesn't give you a whole lot of scenarios to try to figure out how we get from here to there. But that's where the marketplace has really shifted over the summertime, really started around June into July, even before we got to the yen carry trade blow up. The swap market began to say with more and more conviction that rates are going to go down and more importantly, stay there. And so rates that go down and stay there, doesn't necessarily mean a recession in the United States, but it certainly would be consistent with one, as it would be a lackluster recovery after it. Because when you have interest rates that go lower and stay there, that's low growth and inflation expectations. So you have the key part of the monetary system already telling you, not very optimistic about the intermediate and longer term, however that works out in the short run. And that's not the only one. That's just where you start. You've got the copper to gold. Talk about commodities. Copper to gold ratio right now, or at least on Friday, was as low as it had been since August of 2020. It's as low as it was in the depths of 2008 and 2009. That doesn't mean we're repeating 2008. That doesn't mean the marketplace is saying we're going into the same type of thing. But what it says is that there's not a lot of optimism on either side, whether copper or gold, about the intermediate and longer term prospects for the entire global economy, which would be everything we touched on earlier here: Germany, Europe, France, China, the United States stumbling its labor market, that would be consistent with a very low copper to gold ratio. And copper to gold corresponds strongly with interest rate swaps. We see the rising US dollar exchange value, though that's a little bit more volatile. That's another signal that we touched on from the very beginning. The fact that China and Japan are selling US Treasuries, that's another signal that suggests that this is not just a risk of something that could happen next year. It's something that the marketplace is shifting to right now as we speak. In fact, it started over the summertime. So there's a whole bunch of signals, including Warren Buffett and the Philadelphia Summit. Even the stock market is starting to say cyclical risks appear to be rising. And they're not just rising a little bit here or there. It's rising in a way that fits with a whole lot of macroeconomic data, as well as the information that we're getting from the real economy itself. So there's a consistent picture moving in that direction. And it hasn't changed regardless of the Trump election or the stimulus in Beijing or the rate cuts from central banks, which are supposed to be positive and supposed to be stimulative. Marketplace saying all of that stuff that's happening is supposed to be positive, discounting it entirely and still moving in that direction.
You know, you cover this almost daily on your YouTube channel. I think you're like 5 days a week on Eurodollar University. Is that right, Jeff?
6 days.
6 days. That's a lot of work, man. Good for you. Yeah, huge lift. But for anybody who wants to go deeper into any of the concepts that we discussed today, you'll find a new video 6 days of the week, and Jeff goes deep into the crises he's seeing in Germany. Recently, you did a piece on Buffett's activity, but pretty much every concept we've discussed today, you do a deep dive on. And you'll find it very recently on your channel, and then a new video 6 days a week. Anywhere else I should point people to today, Jeff, if they want to hear more from you, other than your YouTube channel, Eurodollar University?
Well, Eurodollar University, it's not, we go deeper into all of these topics. I've got memberships and subscriptions there where the memberships are really about the background. What does the Eurodollar system look like? How is it supposed to perform? What are the signals that we go into that tell you that's not performing? Like I just did a 3-part series on the basics of interest rate swaps and what they're telling you. So there's memberships available for that. And the deep dive analysis, every day I go 2,000, 2,500 words deep into some of these topics that we don't really get a chance to do as you know, Jay. YouTube is not always the perfect medium to really dig into a topic and really go deep into it. So if you really want to get the story behind the stories, that's what we have at Eurodollar University.
I love it, man. Look, Jeff, thanks so much for coming back on the show. I appreciate it.
Oh, it's my pleasure, Jay. Thanks for having me.